Welcome back. This video covers the topic of standard costing and variance analysis. In particular, we're going to look at the definition. We're going to understand how standards are set and calculate the material variance. The standard cost is a predetermined unit cost which is prepared in advance for each element of the total unit cost. This must be done as accurately as possible, since it is this standard which is then used to calculate detailed variances, much more detailed than we came across under flexible budgeting. These variances will then be investigated and used to change activities so that the business's operations are conducted in line with their original plans. A standard cost system is a control device. It's used as an extension of the flexible budget, but it also has other uses. It can help with setting selling prices, planning resource allocations for the future. It's often used as a target so that managers and their staff will have a target that's set for them that they should achieve, and their performance will be judged against achievement of this target and possibly linked to performance related pay. And it's also used as a valuation method for inventories. Just like FIFO, LIFO and AVCO, standard cost can be used to value our opening and closing stock. Now, businesses have many sources of information which they can use to set a standard. If you look at direct materials, for material usage, they will look at things like product specifications, historical data on quantities used in the past, maybe data from current or potential suppliers. For the price, standard price that's been set, we would look at previous prices charged, price lists from our suppliers, projected inflation, information that's been gathered from market research. For our direct labour standards, the labour efficiency element, again, historical data will be important, but also you can look at potential changes to working patterns, new machinery that's possibly going to be introduced and how the direct labour will interact with that new machinery. Time and motion study historically was often used to set labour efficiency standards. The labour rate, obviously past labour rates are important, but so are current negotiations with unions and other bodies. The minimum wage or the living wage will also come into the calculations. The overhead absorption rate, now that has always been a standard. The OAR that we've calculated time and time again, if you remember the formula, it's budgeted fixed overhead expenditure divided by budgeted level of activity, and that is a standard. It's our expected overhead absorption rate. It's a planned figure. It doesn't relate to actual, and it's only at the end of the period that we calculate the under or over absorption of overheads. Before we go any further, I do want to mention some terminology. The idea of budgeted, we've been talking up here about the budgeted fixed overhead expenditure. When we talk about total budgeted cost, we're very much talking about our budgeted units and our standard cost per unit. We will see that in a few minutes. If we talk about the total standard cost, that will be our actual units and our standard cost per unit. We used that in our flexible budget. And then obviously the third element, actual units and actual cost per unit. So we're going to have a standard cost based on expected price and usage of resources, the material, labour and overheads. Once they've got this expected standard cost, this will be put into a standard cost card based on the costs of relevant resources. Here we have a standard cost card. It has all of the elements to make the total cost of this particular unit. For each product that a business creates, there would be a standard cost card. So this is one of many cost cards. For example, we can use this if the actual production is 950 units, we can then calculate the total standard cost. 950 times £82 equals £77,900. Let's just look in a bit more detail at material A. Let's assume that our actual cost is 12,050. If we were doing a flexible budget, we can now calculate the total variance. So there's our flexible budget, our actual and our variance. So we're looking at material A. We've got our actual cost, 12,050. Our flexible budget is going to be £2 per kilo times 6 kilos multiplied by 950 units. And that comes to £11,400. That will give us an adverse variance of 650. In standard costing, what we're going to do is we're going to split that 650 variance. We're going to take it and divide it into price and usage. We're going to be examining in particular how accurate was that £2 per kilo. How accurate was that 6 kilos per unit? Let's look at a full example. First thing that we're going to do is to calculate the total material variance. And I'll calculate this firstly just like I did above. So we can calculate the flexible budget, our actual and our variance. And so we're looking at materials. And in this question, our standard material cost is £100 per unit, or we could say alternatively 10 kilos of material at £10 per kilo. So £100, and we've got 1,000 units produced. So we've got £100,000. Total cost, we were given that in the question, was £98,600. That will give us a variance of 1,400 favourable. And that's how we actually calculated our total variances when we were looking at the flexible budget. I'm going to show you a different way to do it, which can be easier and can be quicker. We can calculate our total variance by taking our total standard cost, which in this case was £10 for 10 kilos at 1,000 units, and then less our actual cost, which was 98,600, and we have 1,400 total material variance favourable. We expected our costs to be, for 1,000 units, we expected the cost to be £100,000. The actual cost was less, so we have a favourable variance. I'm now going to split that favourable variance into my material price variance as follows. To buy, and we actually bought 1,700 kilos, and that should cost £2 per kilo. That's what we expected that to cost. Oh, sorry, £10 per kilo. It did cost 98,600, and that gives me a favourable variance of 18,400. We bought our material significantly cheaper than we expected. We can work out how much we paid for it. We just take 98,600 divide by 11,700, and 98,600 divide by 11,700, and we actually paid around about £8.43, a significant saving. Let's look at the material usage variance. To make 10,000 units should take 10 kilos per unit, a 100,000 kilos. Sorry, 10,000 kilos. Did take, that was 11,700 kilos, and there in kilos we've got a adverse variance of 1,700 adverse, and that's in kilos. What we have to do to get it into a monetary form is to multiply by our standard price of £10 per kilo, and that will give us 17,000 adverse. So we bought more cheaply, but we actually had to use an awful lot more. So the story behind this could be that we bought a cheaper, lower quality material, and that adversely affected my usage variance. If I assess the policy as a whole, I have got my two variances. If I add those together, they will come back to my 1,400 favourable. So my overall policy of buying cheaper but less efficient materials could be said to be successful. My cheaper materials did take more to make my actual level of production, but overall I ended up with a favourable variance of £1,400. As you can see, my material price variance plus my material usage variance comes back to my total variance. Thank you very much for listening.